Hello and welcome to Accredited Real Estate Schools. This is our third quarter 2021 real estate update. I'm Bryan Church. I'm a member of the Education Department at Accredited Real Estate Schools. And this update is for information purposes only and is not intended to be used as investment advice. So what we've found out is that in the third quarter, we've been looking at some of the different states: California, Arizona, Florida, Hawaii, and even Utah. And we found that some places in California are still good areas to invest. Even with the number of people leaving California due to the state's housing situation, on average, people moving out of California are only getting 33 square feet more space and paying $27,000 less in price for properties they're buying in other states. This data came from American Van Lines in 2020. Of course, that was during the pandemic, so you have to, of course, factor that into your analysis. This seems to be fairly insignificant when you consider that California continues to be one of the leading economic powerhouses in the world. And you see that when you look at other states. Like you look at California's economics, and then you compare that to, say, Park City, Utah. It's a really nice area of Utah. A lot of that money is coming from outside of California. Outside of Utah, from California and other places. And then in Florida, they don't have the economics there as well. And in Hawaii, properties are on the market 6 months sometimes. And in California, we had an offer just the other day. There was 11 offers on it, including the one that we had. And so California still looks like it's going to be really, really good economically for the future. It's just that some of the areas in California have been having some issues, and we'll talk about those. California's larger cities have become riskier real estate investments because of the uncertainty caused by large homeless populations and civil unrest that may occur at any time. These reasons, less risky areas located outside of major city centers seem to be more favored by today's real estate investors. So if you see the graphic there, outbound states: Illinois, New York, California, New Jersey, and Maryland, whereas the inbound states are Idaho, Arizona, South Carolina, Tennessee, and North Carolina. So we've had inbound and outbound. The thing with that I have discovered is that I don't think that the amount of outbound in California is really going to have much effect on the other outside areas, outside of the major urban areas, because of just the fact that the economics that we have in California. And then let's look at the National California Economic Forecasts and see if we can figure out why that is, explain it. Interest rates are expected to stay low for a long period of time because if interest rates are increased, the U.S. Treasury will not be able to service, which is pay the interest that's due, the constantly increasing national debt, which is $28 trillion and growing. This means that at some point, the U.S. government will not be able to pay the interest payments on the national debt. So what the government is going to have to do is inflate the U.S. dollar so that they can pay the dollars back with cheaper dollars. And that's what they've been trying to do for the last 10 to 15 years with no success, but they continue to do that, and they may actually have some success here coming up in the future. To ensure that the U.S. government can pay the interest payments on the national debt, U.S. Treasury will try to inflate the U.S. dollar and pay the national debt back with cheaper inflated U.S. dollars. Interest payments that are being paid by the U.S. government to investors who bought the U.S. Treasury bonds and notes, right, will be worth less than they were worth when the money was originally loaned to the U.S. government when these U.S. Treasuries were purchased. This is going to be caused by inflation. So let's look at inflation on this, because this is important, because we've been in a deflationary for probably the last 10 to 12 years, and we may be starting to get some inflation here in the near future. Inflation occurs when there's too much money chasing too few goods. When the U.S. government continues to print more and more money, this could be the start of inflation. However, money printing by itself does not cause inflation. Money printing along with an increase in the velocity of money is when inflation normally follows. And what that means is that you can print a lot of money, but if the people are not spending it, then you're not going to have inflation. Velocity of money occurs when there's a multiplier effect as money changes hands from one person to another. For example, person A pays $10 to person B for the purchase of an item, right? Person B uses the $10 received from person A to purchase an item from person C. C uses the $10 received from person B to purchase an item from person D, and the process continues. What happens is that original $10 paid by person A becomes $10 plus $10 plus $10 equals $30 in economic productivity. The increase from $10 in value to $30 is called the money multiplier. In this case, it's 3 times the amount, and that measures the velocity of money. Velocity is needed for inflation to occur and start devaluing the US dollar. So what's happened is during and immediately after the COVID-19 pandemic, people were scared to spend money and either increased their savings or paid down credit card balances. Of course, neither of them caused an increase in the velocity of money nor a subsequent increase in inflation. So you may have some money printing, but people are not spending the money, then you're not going to have the inflation. And as excessive money printing starts to occur and people start to anticipate, and this is what's happening right now, inflation will appear in the future, they may decide to buy larger items earlier than planned to get a lower price than if they were purchased at a later date. These purchases increase the velocity of money, and maybe the start of a real inflationary cycle could last for decades. Some of the experts think that inflation could go on for two decades or more, so that's pretty significant. So people are making bigger purchases, and of course, real estate might be one of those. In contrast to inflation, the U.S. economy is presently fighting against strong deflationary forces caused by aging demographics. The baby boomers are retiring, so people are retiring, a big group, and it's deflationary because they're not spending any money. And the technological innovations, technology making things cheaper to produce and services easier to provide. And that's the second factor causing deflationary forces is the technology. So demographics and technology, we've had the deflationary forces have been going for the last 10 plus years. And what happens is this will slow down the arrival of inflation until much later than people expect. Inflation's expected to kick in around maybe late 2022, with hyperinflation may occur sometime after that. And with hyperinflation is really, really bad because inflation's out of control, and that could very well happen in the future, as well as, of course, just regular inflation. The U.S. government has adopted a monetary policy called Modern Monetary Theory, or MMT. And matter of fact, we're going to be coming out with a video, an audio PowerPoint video that will cover the MMT very extensively shortly, so you can get an idea if you want to learn about MMT, what it means. The theory believes that the U.S. government can print as much money as it wants until inflation appears, then can use taxes, by taxing the population, cool down the inflation, similar to turning a faucet on and off. Now, the bad news on that is that, unfortunately, inflation does not work this way. Inflation can suddenly morph into out-of-control hyperinflation with no way to stop it. Increase interest rates by 18% or higher, like the Fed Chairman Paul Volcker did in 1979 and 80, which was a pretty brave move on his part at that time to do that, and it actually stopped the hyperinflation. Hyperinflation will cause the U.S. dollar to become worth less and less over time. This causes people who have pensions, fixed income annuities, bonds, and slow to increase wages, which is probably just about everybody in the services sector, to be hurt the most. Prices of goods increase while their income stays the same. That's the danger of hyperinflation, and that's where people need to take action now to hedge against that inflation that we think is going to be coming up down the road. People who will survive the mass devaluation of the U.S. dollar will be the ones who are the early movers into inflation hedges, such as real estate. Inflation hedge is an asset that is purchased because it will maintain its value through both asset price inflation, that's when the assets increase, and consumer price inflation, when consumer prices increase. Real estate's been a really good inflation hedge over the years, and the reason for that, it's been a traditionally inflation hedge over the years, mostly because it's a tangible asset. Real estate income properties such as multi-unit residential apartments have been excellent inflation hedges because they usually generate income, increase in value over the property owner's holding period. At least we hope so, right? And everyone needs a place to live. Apartment owner can always rent an apartment to someone for some rental amount, even though it may not be as much as the rent as the owner would like to collect from the tenant who occupies the property. And that's why the multi-unit apartment buildings have been more popular than leased investments, because with leased investments, they're a lot more dangerous, because when the tenant goes out of business, you have no income coming in at all. It may be difficult to find another tenant in leased investments. Those would be like retail strip shopping centers, office buildings, things of that nature. And those have been a lot more dangerous. Matter of fact, in the past, what has happened is there's been a progression of real estate investors from single family to multi-unit to leased investments, and then they end up with single tenant properties at the end, like single tenant retail buildings. And that used to be the progression, but now with the changes that we're seeing in the marketplace, you're seeing that a lot of people are going back to the apartments and staying in the apartments and staying away from those leased investments because of the danger we're having. The retail was being hit by the online retailers like Amazon, and so that was reducing the retail values of the retail properties because of the tenants not needing them as much because they could do online retailing. And then office buildings have been affected by the pandemic because the business owners have realized that they can actually operate without having huge office locations. And so that's going to reduce the office building values as well, because tenants aren't going to need those. So people are, instead of going into those leased investments, they're going backwards and going into the apartment building. That's why there's such a huge demand for apartment buildings. That's why the capitalization rates, which is the amount of money an investor is willing to receive in income if they pay cash for the property, are going down. So they actually will accept less and less of a return from a multi-unit because it's a safer investment. Okay, and so anyway, that's the situation with the apartment buildings. And in old apartment buildings located in lower socioeconomic neighborhoods have become a challenge due to the COVID-19 pandemic and eviction moratoriums issued by the Center for Disease Control, which is the CDC, State of California, and local county and city housing authorities. Many tenants have stopped paying rent, and landlords have not been able to pay the debt service on real estate loans that were originated to provide leverage during the investor's holding period. So what they do is come in with, say, 25% down or 50% down and leverage the investment. The problem is now you have the debt service, and if there's no income coming in, how are you going to pay the debt service? So the government's COVID-19 funding programs have partially helped both the tenants and property owners. However, many of the properties have been under the eviction moratorium since the early part of 2020, when around March or thereabouts is when it came in, and are behind on rental payments to the property owners. Consequently, property owners are behind on mortgage payments to the lender who loaned the money to the property owner when the property was originally purchased. And there's been some money that's been sent out, but a lot of that has not been, distributed out to the entities. So we'll see what happens on that down the road. Apartment complexes located in higher socioeconomic neighborhoods tend to be better long-term investments because tenants usually have better jobs, greater income durability than tenants of older apartment buildings located in lower socioeconomic areas. As a apartment owner, what they're looking for is three things. One is they pay the rent on time, and they stay there for a long period of time, and they don't eat the property up while they're there. And so that income durability is really the big thing in the higher socioeconomic neighborhoods, and you probably see that there'll be less of the eviction issues with that moratorium in the higher end properties than you will in the lower end properties. At least that's what I've seen. So real estate has traditionally been an excellent inflation hedge because it has the advantages of earning income and increasing value during a property owner's holding period, and real estate prices tend to track inflation. So real estate has been a really, really good one. And in addition, of course, real estate is an excellent deflation hedge. A lot of people don't know this because the rental income that's earned during the property owner's holding period is worth more in the future than it's worth today. So when you're having a deflationary period, those rents you're going to get in the future are actually going to be worth more to you. So in other words, future rents are worth more than present rents. And so real estate works good both ways, inflation and deflation hedges. Real estate property owners tend to win both ways. Real estate is an inflation hedge because it tends to track inflation during inflationary times, and deflation hedge because rents collected in the future will be worth more than rents collected today. All in all, California real estate still looks to be a good investment opportunity if purchased in less risky areas outside of the urban city centers, such as San Francisco and LA, which are having the most issues there. So the bottom line is that it looks like California is still a good place to invest. There's a lot of money here. It looks like maybe just invest in some of the geographical areas that are outside of that risk factor. And you still have people who have a lot of money and have a lot of money to invest. So anyway, that's our third quarter 2021 real estate update. I'm Bryan Church, and I'm, of course, part of our education department at Accredited Real Estate Schools. And so if you please, if you like us and also subscribe to our channel, we can continue providing these updates to you. And if you have any real estate needs, you can always give us a call. Thanks.